In the past few days, the stock market has been very unpredictable. We can see it go down and then it's quickly going back up. All of this adds even more uncertainty as to what to expect in the next few days. Just a couple of days ago, we started seeing what looks like might be an upward trend, but is it really? Or is it just another period of a positive kickback followed by another decline? Hi, my name is Oleg, and today we're going to talk about the stock market. No one can predict where the stock market is going, and I am no exception. I wish I had a crystal ball or a deck of tarot cards to know all the answers, but unfortunately that's not the case. So in this video, I'm not going to answer whether we hit the bottom and started recovering, or the worst is yet to come, but instead I'm just going to give you some of the market indicators that may move the market up or down, and based on that, it's up to you to make your own judgment on where it's going to go from here. First, let's take a look at some of the indicators that point that the stocks are going to go up, and the first one on my list is the unemployment rate. In January 2020, the unemployment rate hit 3.5%, which is the lowest that it's been in over the past 50 years. But then COVID happened. People were getting sick, businesses were shutting down, and a lot of them were even closing permanently. And in April of 2020, the unemployment rate hit the all-time high in the history of the United States, reaching a whopping 14.8%. But then the vaccinations and safety practices in place led to a rapid reduction in the unemployment rate, and as of now, for the month of January 2022, the unemployment rate is sitting at 3.9%, and the projections look like there is room to go down even more. All due to the fact that more jobs are being created, and for now the job market is not having enough supply to meet the demand, which leads to higher salaries and employees feeling more confident about their jobs and also feeling more confident about spending their money, which in turn leads to a higher cash flow for the businesses, which makes the stocks look like a good investment and drive the market up. The second indicator on my list is slowing down inflation. Throughout 2021, the inflation has been creeping up month by month, and by the end of the year reached 7%. Considering how the average inflation in the US in the past 10 years has been sitting at 2.47%, that is a pretty significant bump, and in my opinion, very unsustainable. And it should get fixed either by the market itself or with the help of the Federal Reserve. Especially after the Federal Reserve meeting, we are expected to have an increase in interest rates coming in March and many more interest hikes, as many, including Goldman Sachs, predict multiple interest hikes throughout the year. And the fact that the unemployment rate is going towards the pre-recession levels is going to facilitate raising interest rates for the Fed, because their job is to tame inflation without hurting the labor market. And I know what you might be thinking, because logically, raising interest rates should drive the market down, but according to Market Watch, since 1994, over the periods of multiple interest rate hikes, DJIA and S&P 500 experienced significant growth, which is 54.9% for DJIA and 62.9% for S&P 500, which is almost 3 times higher than the average growth experienced during the periods of the interest rate cuts. Another argument that I have about the market going up is the reduced PE ratio. PE ratio measures the current market price divided by earnings per share. PE ratio is the multiplier that is used to say how cheap or expensive a stock is priced by the market compared to what it can be worth in the future. The lower that multiplier is, the cheaper the value of a stock is perceived to be considering the value that it's offering, and historically S&P 500 has been sitting at around 13 to 15 for PE ratio, but I think it's shifting a little bit higher nowadays due to Robinhood and Webull offering easier access for the general public to invest. On June 29, 2021, the PE ratio for S&P 500 reached a whopping 45.56, and the recent one that we've seen on February 1st is sitting just under 26, which is a 20-point drop from the recent all-time high, which can be seen as a starting point for the market to see stocks as a good value. Now that we look at some of the indicators that point at the market going up, let's take a look at some of the indicators that point at the market going down. And the first one on my list is, unsurprisingly, inflation going higher. And the reason for that is the ongoing supply shortage that started a while ago and that doesn't seem to get resolved anytime in the near future. It all started with shutting down the factories in the region with the most global production capacity, such as China and Southeast Asia, since the beginning of the pandemic. And then when the world started to recover and the demand just kept piling up, but then the logistics problem came up, and all those goods are just sitting there in the warehouses ready to be delivered, but container shortage as well as reduced workforce at the destination countries required to unload all of these shipments is leading to the ships not being able to dock at the ports and just sitting there in the open water near the ports for days if not weeks. That leads to reduced supply to basically everything, and as you know from the basic economic principle, where the demand is high and the supply is low, the prices are going up. Another reason that we've already talked about, and that's also another side of the coin, is the increased interest rate by the Fed. So when the Federal Reserve increases interest rate, it means that now it's more costly for the banks to borrow from each other overnight, and the increase in the costs is going to be passed on to the consumer in the form of the increased mortgage, credit card, auto loan, and personal loan rates. Which means that the general public has now less money to spend and invest, meaning that businesses are going to get less business, slowing down the cash flow, and it's going to just lead to even stronger negative market sentiment on top of the fact that the general public has less money to invest and is going to be more diligent about their investment decisions. Another reason for the market to go down is increased yields on Treasury bonds. Normally when the Fed raises interest rates, the Treasury bond yields follow along, which might make some investors switch to the Treasury bonds as they're seen as a safer option, which are especially attractive during the times of volatility and uncertainty, which means that the funds are going to be leaving the stock market, and as we know, when the sell-off happens, that's when the market goes down. And the last reason is the general market sentiment, including institutional and retail investors, being scared of the market dropping even further, so they're going to be making huge shorts, which is going to drive the market even more down, especially in these times of uncertainty. I had one more argument on my list that could indicate where the market would go, but unfortunately I didn't see it either as positive or negative, and that one is the small cap stocks. They're considered to be a good indicator because small cap stocks are considered to be more volatile and more risky, meaning that the investors would usually venture into those for higher returns, and they would only do that in the periods of a steady bull runs. But when there is volatility and uncertainty on the market, they would usually reallocate their funds into safer bonds and blue chip stocks. And looking at the Russell 2000 index in the past couple of days, we can see that it's been basically trailing the S&P 500 index and even fallen a little bit behind. And until we can see a steady growth or a steady decline in the Russell 2000 index, which is going to be significantly different from S&P 500 index, we cannot really use it as an indicator of whether the market is going to go down or going to go up. And that was it for today. If you enjoyed the video, smash the like button for YouTube algorithm, subscribe if you haven't, and buy the dip. Bye!